GDP print that represents the economic activity internally within an economy. Now, before we dive deeper into the components of GDP, I want to discuss one thing with you guys and girls, and that is the 3 tiers. There are 3 key groups and tiers in an economy, and first we have consumers, then businesses, and then governments. As I like to say, there are millions of consumers, way more than businesses, and hundreds of thousands of businesses compared to each one government of an economy. I will loop back to this after covering the components of GDP, but before we move it is important to note that there are 3 groups in an economy: consumers, businesses, and a government. So guys and girls, here we have GDP at the top here. And I'd like to note that there are 5 key components inside GDP that are printing data every single week, and this data that we're going to discuss gets grouped into a component, and this component adds to GDP. So let's start with consumer consumption. There are 2 key data points for consumer consumption. We have consumer confidence and retail sales. Now, let's work through each individual data print logically. And for those of you that don't know, the data prints are easily trackable online on sources such as Trade Economics, Forex Factory, and so on and so forth. Now, consumer confidence. It goes without being said, unless a consumer is confident, he or she will not spend inside of that economy. There'll be no spending, there'll be more saving. Consumers will feel, due to their consumer confidence, that the economy has tougher times ahead. Therefore, instead of spending their disposable income as and when they wish, they are likely going to save the money for the times that are ahead. One key indicator that can resemble and represent how confident consumers are of course the retail sales. The more retail sales are creeping up, the more consumers are spending and the more businesses are earning. That is the consumer level of an economy. Let's jump into the business investment. Now, there are 3 key data points within the business investment. You have business confidence, how confident are business owners, manufacturing PMIs, and PMI standing for Purchasing Managers Index. Is the manufacturing sector expanding or is it contracting? Same goes for service PMIs. There are 2 key data for government investment, and this is debt to GDP ratio and current account. There is 1 key data point for net exports, which is balance of trade, and then a component and all-in-one data release as well, which is unemployment and employment. Now, you're probably looking at me thinking, or more so listening to me thinking, what is this guy on about? What does all of this represent, and how is this interlinked, and how does all of this add up to make GDP? Let's take a look. So let's start off with consumer consumption. Now, this is a data category or component, however you'd like to refer to it, that represents the consumers in the economy. And there are 2 key data points that get released to us monthly, quarterly, annually on consumer confidence, more so monthly with them, and on retail sales. And of course, this data can indicate to us how the health from a consumer stance is looking inside of the economy. Consumer confidence. The Consumer Confidence Index is a measure of how optimistic or pessimistic consumers are about the state of their economy in the near term, collected by the government. Consumers prefer to spend more on products and services when they're feeling confident about their economy, which in turn helps the economy with the revenue and businesses grow. Whereas if consumers are not confident, sales of products and services will decline if buyers are gloomy, dragging down the economy with them, and of course businesses start to decline. The more confidence, the more spending. Retail sales. Retail sales is an economic indicator that can be used to determine how well an economy is doing from a transactional point of view. The report provides an overall assessment of the retail sales of products and services throughout the month. Consumer spending is a crucial indicator of economic activity, leading traders to track the data as it may impact the financial and fiscal decision making within the economy. For instance, rising consumer spending results in rising business output, which in turn boosts the economy, taxes are being paid, growth is on hand, and there is encourages for foreign investment. This will then have an effect on other important economic factors, including orders for durable goods, balance of trade, GDP, inflation, just to mention a few. But we're going to cover all of these shortly. Business investment components. There There are three key data points: business confidence, manufacturing PMIs, and service PMIs. So, business confidence. It's similar to consumer confidence, but in a business context, based on surveys on changes in revenue and other business health indications such as completed goods inventories. The Business Confidence Index forecasts future developments within an economy. It can be used to track output growth and foresee tipping points in the economy and its activity. The more confident businesses are, the more they will hire and reinvest in the economy. Manufacturing PMIs. The Purchasing Managers Index is a monthly survey of businesses that measure whether the market is expanding, decreasing, or remaining stable from a manufacturing sector perspective. It provides information about the present and foreseeable business conditions within the sector. Service PMIs. The data is based on interviews with over 400 executives from private service companies. The subjects of the study are transportation and telecommunications, financial intermediaries, businesses and personal services, computers and IT, hotels and restaurants, just to name a few. Now, a number above 50 indicates an improvement and a number below 50 indicates a deterioration. And for manufacturing PMIs, a number above 50 indicates expansion within the manufacturing sector, and below 50, of course, you got it, indicates a contraction. Government investment components. There are two key data points: current account and debt to GDP ratio. A current account records a country's transactions with other countries, specifically net trade in goods and services, net income from cross-border investments, and or overall net loss. The lower the current account, i.e. the more negative the current account is, the greater the increase in dependency on a government to bail out corporations or offer supportive fiscal policies to consumers within the economy to encourage spending once again. Debt to GDP ratio. The debt to GDP ratio is the ratio of a country's public debt, measured in the currency's unit, to the country's gross domestic product output. It is a 1 to 100 ratio, meaning if a country has a 95% debt to GDP ratio, for every one singular unit of currency made in GDP, the economy and its government owe 95% out in debt. For example, if the UK has a 97% debt to GDP ratio, for every £1 made in the UK, the economy owes 97 pence debt. Net exports components. There is one key data that represents net exports and is balance of trade. The definition of balance of trade is the difference between the value of a country's exports and the value of its imports over a specific period. If an economy is importing more than it is exporting, it is essentially spending more than it is making, and vice versa. The difference between the export value and the import value is expressed in the currency unit of the country. For example, if the economy exports 5 billion Great British pounds worth of goods and services, while simultaneously importing 3 billion pounds worth of goods and services, it has a positive of 2 billion within the balance of trade, and we know this to be a positive balance of trade for the economy. Employment and unemployment. One key data point for unemployment and employment, it's in the word. When an economy has record low unemployment, or also known as sky-high employment, it increases the probability of spending occurring in the economy, which leads to an increase in the transactions that are occurring. If consumers are spending more, business revenue more, and governments earn more taxes. This is the key to a strong economy. If consumers aren't spending, businesses aren't earning, and the government must support, stimulate, and potentially bail out their economy via reserves and funding. Let's jump back into this visual representation of the GDP components that we drew up earlier. Now let's take consumer confidence. The more confidence consumers have, the more retail sales will be increasing. The more businesses will be confident due to sales coming inbound, and due to this, the manufacturing sector likely expands alongside the service-based sector. The government has to lay less money into the economy, support their consumers less as consumers are earning more, spending more. We are seeing transactional-based economy increase. Therefore, the government should be spending that surplus on the debt that they've raised, and the debt to GDP ratio should decrease. The current account from here, meaning that the government has to put less into their economy, they're likely making more from exports, which we'll get onto. The current account should increase. And from here, of course, the currency starts to strengthen because investors notice consumers are spending due to their confidence being high and retail sales reflecting this. Businesses are confident and the manufacturing PMIs and service PMIs represent this as we are in expansionary phases in the sector. Debt to GDP ratio starts to drop whilst the current account picks up and the currency starts to strengthen, meaning businesses inside and consumers inside of the economy are spending less native units of their currency on importing, as it is a stronger currency overall now, and balance of trade will likely increase into the positive territory. Due to this, both manufacturing-based businesses and service-based businesses can't keep up with the demand. They need to hire more staff to then expand and grow, refer to the economic cycle here. And of course, due to this need for more staff, the economy tends to expand. So businesses tend to employ, employment increases, and of course unemployment decreases. Now, due to this, more employment is occurring in the economy, so consumers consume more, businesses invest more into the economy because they're growing, government investment tends to decrease, which is a good thing. The government is putting less money into the economy to support their own consumers and businesses, and the economy is exporting more than it's importing, and the economy is now growing. Now, if we go the other way, consumers aren't confident, you're likely going to see retail sales drop. Due to this, businesses also will not be confident, and the PMIs start to shrink and become in a declining phase. Debt to GDP ratio starts to increase, whilst current account starts to decrease. The government will be going into a deficit, meaning they are going over budget. If they were under budget, they would generate surplus. Balance of trade is dropping due to a weak currency and the business activity dropping, and unemployment starts to increase whilst employment starts to decrease. These are the components that will make or break a GDP. If consumers are confident in spending, businesses are making money and they're happy, the government are less obliged to stimulate and support their own economy. Therefore, the businesses are expanding and growing and exporting more goods and services from the economy, therefore making more money. And of course, to keep up with this demand, consumers are hired. This then relapses into consumers being more confident and so on and so forth, which would increase GDP. Vice versa for, of course, a decrease in GDP. It's evident that without consumers consuming, businesses take in less revenue, which leads to a decrease in business investments. And of course, as a result of this, the government is likely to pick up the slack via their budget, which increases the debt to GDP ratio. While the currency is weakening due to this, weighing in on net exports, the likelihood of this is that an increase in unemployment will occur as businesses struggle to survive, make cuts, and have to dial back to generate a margin. Referring back to the triangle of society here now, we remember consumers, businesses, government. We now know that consumer spending keeps businesses alive, and in turn, the taxes are paid to keep the government afloat. Without taxes and income to the government, they must dip into their own pockets in times of need. Just to recap, consumer spending, businesses revenuing, governments taxing. Now let's put it all together. Each data component within GDP has a very valid reason for being there. The collected data is compressed to then generate a percentage gain or loss in GDP, leading to, of course, an internal reflection of the overall health of the economy. Ideally, we would like to see GDP in the positives, showing signs of strength in economic output, but this isn't always the case, as it is natural for economies to go through phases of both upswings and downswings, known as peaks and troughs.